Hey everybody, Greg Towner here with Parallel Portfolios. Before we get into it, just wanted to thank everybody for all the feedback we received on our new longer form podcast / video that we did recently. I had a lot of views for that. It's now available on both Apple Podcasts as well as Spotify. But as we promised in that video, we're going to continue with our normal format, regular monthly videos. We've actually rebranded it here as 5 charts in 5 minutes. So with that, we better go ahead and get started. Well, you know that we like to start off taking a 3-year or longer look at the S&P 500 just to see what the market is doing. Since we spoke with you last, the market's actually had a bit of a rally off its lows, still within the context of this kind of short to intermediate term downtrend. We've been saying for months that we don't think we're going to have a V recovery like we all saw back in the COVID period of 2020. And that's already proven true. And we've had, one rally here, one rally after that. We're currently in the midst of a rally. Whether it goes higher from here or what have you is hard to say. Certainly think there's a possibility that we still see more new lows. That's hard to predict. What we do feel more confident in is it's going to take some time. It's going to take a period to kind of work through a lot of things right now. Well, one of the positives that we've been talking about and we can continue to talk about is sentiment. A lot of different ways we look at investor sentiment, consumer sentiment. This looks at the US Index of Consumer Sentiment going all the way back to the 1950s. We recently reached a new low in consumer sentiment, despite the job market and everything else that's positive. We know that there's a lot of things, inflation on the top of everybody's list, that's negatively impacting people's views. Now, we don't necessarily view sentiment itself as an indicator to push the market higher, but at some point when there's some sort of catalyst to improve financial markets, a lot of people will be caught off guard and need to readjust. Some of those people might be other investment professionals. This is a survey of global fund managers. When the blue columns here are to the downside, it means that they're investing more in bonds than they are in stocks. The timing hasn't been great. I mean, look at here. This is March 09. This is the bottom of the financial crisis when stocks started an enormous rally. Professional money managers had their most allocated to bonds at that point. You can see here in the in the COVID period, same thing. That was a very brief period, hard to judge. So how's this going to play out? Now we're seeing them, global fund managers, allocating more to bonds. Could it go much worse? Certainly it could. But at some point, we're probably going to look back at this and say, oh, people were too defensive at the worst possible time. When that comes, hard to say, of course. Well, we don't talk a lot about currencies here recently, but we think it's important to do so this month. This is a chart going back about 10 years of the US dollar index. It judges the US dollar against a variety of currencies. And as you may know, the dollar's really had a big run here recently. In fact, it briefly reached parity with the euro. It hasn't done that in, I believe it's around 20 years or so. And so this is great if you're traveling abroad or if you're a company importing some goods. But if you're one of the big US corporations, we're doing a lot of business internationally, and we're seeing a lot of corporate earnings announcements saying that the dollar has been hitting their earnings. So that is what we're seeing right now. It's a short-term effect on earnings for corporations. You're going to see them talk down a lot about foreign currency exchange. It's hard to predict currency movements. It tends to be quite volatile. So we tend to view it as a shorter-term thing, but it can have big repercussions, not only in earnings, but across commodity markets. It costs a lot of trade from different countries. So something that we're keeping an eye on. Well, of course, it seems like every time we talk now, we're talking about recession. So let's take a look at another survey that comes from the global fund managers. And this looks at how likely they think a recession is going to be. Let's go back to the great financial crisis. A recession had already started down here, early 08, I believe that is. They reached their most likely point, again, at the very low for stocks. They said, oh, a recession is definitely likely. We saw in the previous charts that they were underallocated to stocks at that time. So worst possible timing for their opinion. Again, here in COVID, very unusual period, obviously. It was almost an intentional economic shutdown. But again, global fund managers were looking at recession being likely at the worst possible time as far as when to get invested. Now, this period right now, of course, we'll see how this plays out. This is pretty interesting because certainly this number could go higher, but it seems like everybody in this day and age is trying to get ahead of things, trying to get ahead of what the market might do or what the economic language might be. Clearly the market has already, at least to some extent, factored in the possibility of the recession. So we're recording this on Wednesday. By the time you receive this video, the quarterly GDP number will have already come out, and you will have seen the headlines claiming we are either in or not in a recession or what have you. As we mentioned in our recent long form video, the GDP is really not used much by the National Bureau of Economic Research to determine an actual recession. They look more at the job situation, which is really good, and some other things. So we think you can mostly ignore those headlines, and the market will probably most likely ignore them. But we are going to be interested to watch, see how this number moves over time and see how it reflects with what stocks do, because more often than not, people are caught off guard and they're trying to fight the last battle and trying to get ahead of things when that isn't often the case. I want to leave you with this quote from Mark Twain and a couple of related thoughts. So, of course, Mark Twain has a lot of quotes. Some may or may not be related to him. The art of prophecy is difficult, especially with respect to the future. I think there's probably no more time that this is true than right now. There's so much going on in the world. It's very easy to make a bearish case for stocks and negative case for the economy and so forth. But believe it or not, there are ways that you can make a positive scenario, a positive story for things. But it's just difficult to predict with any accuracy, not only how the world is going to evolve and the economy is going to evolve, but then drill it down to how stocks and bonds might, react to that. So to us, we look at it as, by the time, if you're waiting for the future to look clear and everything to look easy and clean, the stocks will have already factored that in long before and be much, much higher, most likely. So to us, it's better if you have cash on the sidelines, you've been waiting to get invested. It's probably good to start dollar cost averaging into the market, trying not to time things so much. If you are invested, focus on your long-term plan, your financial plan, your asset allocation, following a disciplined investment process. The same things that we always say are even more important now. So with that, if you have any questions about that or anything else, of course, please let us know. We'd be happy to talk to you about it. See you soon. Thank you.